This graphic shows the most basic rule of modern economics. When a country's economic growth starts to stall out, the central bank steps in to slash interest rates. Cheaper borrowing encourages businesses to invest and consumers to spend, acting as a shock absorber for the slowing economy. In April 2026, the Bank of Japan looked at their domestic economy and saw serious deterioration. They officially halved their national growth projections for the fiscal year, dropping their GDP outlook to a sluggish 0.5%. According to the playbook, that weak growth figure should guarantee cheap borrowing for the foreseeable future. Instead, the Bank of Japan signaled a reversal. They are actively preparing to raise interest rates as soon as June. This infographic of the central bank's policy board illustrates the internal friction this decision is causing. Out of 9 members, 3 officially dissented against holding the baseline rate, demanding an immediate hike right now. That is the highest level of internal rebellion the bank has seen since 2016. Japan is abandoning the traditional rules of monetary policy because they are currently trapped. They are caught between a fragile domestic economy at home and a massive geopolitical shock unfolding thousands of miles away. The origin of this financial trap dates back to February 28, 2026, following the United States and Israel's military strike against Iran. Following the attack, Iran retaliated by effectively closing the Strait of Hormuz. This narrow strip of water serves as the central artery for global crude oil and natural gas shipments. With that vital waterway blocked, the global energy supply chain bottlenecked almost instantly. The immediate result was a violent spike in the price of crude oil and gas around the world. For Japan, this price spike hits differently. The nation's entire industrial and domestic infrastructure is built on imported energy, making any disruption to global supply an immediate and direct drain on the national treasury. Because of that dependency, a military conflict over a strait in the Middle East translates directly into a severe, systemic economic crisis in Tokyo. That massive imported energy bill is driving the first force tearing at Japan's economy: inflation. The soaring cost of oil recently forced the Bank of Japan to drastically upward revise its inflation forecast, jumping from 1.9% to 2.8%. To pay those inflated energy bills, Japan has to trade away its own currency on global markets. That aggressive selling has battered the Japanese yen, pushing it down to roughly 159 against the US dollar. This chart tracks that rapid currency decline toward a critical threshold. Financial strategists mark the 162 level as the point of maximum tolerance for yen weakness. To prevent free fall, the central bank must use its remaining weapon, raising interest rates to make the yen attractive. The bond market is reacting defensively. Japan's 10-year government bond yield is surging, recently hitting 2.496. In the United States, the Federal Reserve is also expected to hold its interest rates steady, as geopolitical uncertainty complicates its own policy decisions. The European Central Bank is navigating a similar set of constraints, trying to balance energy-driven inflation against a backdrop of softening industrial growth. This map illustrates the hidden consequence of Japan's signaling a future rate hike. When Japanese interest rates go up, the yen gets stronger. A stronger yen pulls capital out of the global system, as investors move their cash into newly profitable, highly secure Japanese assets. The primary victims of this capital flight are emerging markets. Developing nations rely heavily on foreign investment to grow, but they carry a much higher risk profile than a wealthy, industrialized nation like Japan. When global investors reallocate their portfolios toward Tokyo, they pull that cash directly out of South African government bonds, sub-Saharan sovereign debt, and commodity-linked currencies across the African continent. The era of cheap money in Japan is over. A localized military conflict in the Middle East has dictated the terms of Tokyo's monetary policy, and developing nations on the other side of the planet will pay the price for it.